we are going to look at how to put together the operating section using the indirect method. An example of this is Target's financial statement. You'll notice here that they start out with net earnings or net income, and then they have a whole bunch of adjustments. And one reason we can't say that any of these lines mean something to investors is you might look at depreciation and say they got $3,000 from depreciation. That's not what it means, which is why I said earlier that the only number that really has meaning to investors is the last number, the cash provided by operating activities. All of these numbers by themselves do not have meaning. So you can't say we got $3,000 from depreciation or we spent $854 million on inventory. It's not really what it means. All right, so let's look at this problem here. And we are trying to put together the operating section for Dunder Mifflin. And we are going to start with net income. We always start with net income. Now, why do we start with net income from the income statement? Throughout this semester, we have talked about accrual accounting, and the income statement is revenues minus expenses. Revenues do not equal cash. It's just the amount of work that we did during a period. Expenses are not cash either. It's the amount of resources that we used up. Cash really has nothing to do with revenues and expenses. However, we can say, is it close to cash? This $450,000 from customers right here, that's the amount of work that we did during this year. Is that close to cash? Did most of our customers pay us? And we'd say, yeah, even though it's not really cash, it's close to it. It's a good starting number. So we're going to start with $60,000 as our net income and say, well, that's close to what we got in cash. We know it's not exact, but it's close. We're going to start there. And then we're going to make adjustments for all of the stuff that we know is not cash. The first thing that we are going to look at is all of the stuff on the income statement that we know has nothing whatsoever to do with cash. Sales revenue, that could be a mix between cash and maybe accounts receivable. Same with cost of goods sold. Maybe we spent the money on the inventory this year, so that's a mix as well. So we go down this list and we say, is there anything that absolutely is not cash? And one of them stands out, and that is depreciation expense. Depreciation expense, the journal entry that we do is depreciation expense debit and accumulated depreciation credit. It never has cash in it. So we ask ourselves, if that is never cash, let's take that out of the whole equation. Let's cross that out on our income statement. And if we cross that number out, if this $25,000 expense doesn't exist, what happens to our net income then? It goes up. So the first thing that we do is we adjust for non-cash items. And if these are expenses, we ask ourselves what happens to our net income if this thing didn't exist. If depreciation didn't exist, we have to add the depreciation. So now we're sitting at $85,000. Say, all right, what would our net income be without this non-cash item, depreciation? Well, $85,000. We're a little bit closer now to a real cash number. We took out all the stuff that absolutely is not cash. All right, the next thing that we do after we run through all those items, depreciation is definitely the most common one, but not the only one. It's the only one we're covering in this class, but in future classes, you might cover some things like deferred income taxes and things like that. We're not going to worry about that. Just look for depreciation on the income statement. It's never cash. So add that one back. The next thing we're going to look at are what are the non-operating things. The income statement encompasses both operating and non-operating items. So our day-to-day stuff and the stuff that happens occasionally. In the operating section on the statement of cash flows, we want to isolate just what is our day-to-day stuff. And the income statement might have some things that aren't day-to-day. Sales revenue, that's hopefully a day-to-day thing. That's our customers every day. They're paying us. We might be buying and selling inventory every day. All of this stuff, we can see operating expenses. It's in the name. Those all should go on the statement of cash flows. So those are all included in the net income. We don't have to adjust for those items. Then we get down to this gain on sale of equipment. That's not a day-to-day thing. We're not often selling our equipment, I think. So we look at that and say, that's not an operating thing. We need to take that out of the operating section. It actually belongs in the investing section. So if we're putting together the operating section, let's pretend that doesn't exist. So we take out this $8,000 and say, all right, what happens if that doesn't exist? Well, our net income would actually go down. So we are going to subtract our gains on non-operating things. Usually these are gains on sales of equipment and gains on sales of buildings and such. So we would need to subtract that to get to a better operating cash flow number. So subtract that one. Well, what if it's a loss? The loss would have reduced our net income. So if we cross a loss out, we actually have to add the losses back. All right, so I do want to point out this does not mean we lost $8,000 in cash on selling this equipment. The reason we're subtracting the $8,000 is this is not an operating thing, and we're trying to get to operating cash flows. All right, so I think we're at a good spot where everything else is considered operating. You might wonder about the interest expense. Doesn't interest expense go in the financing section? The answer is the principal paid on loans, yes, that belongs in financing, but interest, we leave it up in the operating section. It's fine. So just leave it there. Don't do anything with the interest. Income taxes are also operating, so we'll leave those there. Don't do anything with those. They're included in the net income, and they rightly should be. All right, so now we have to ask ourselves, did all of these items on the income statement include cash, or was it a mix of stuff? I like using the sales revenue as a good example. So we look at the sales revenue, and it says $450,000 from our customers. And that could be close, but it might not be exactly what the amount of cash we got from our customers. Some journal entries would be something like cash, $5,000, and sales revenue, $5,000. That's okay. That's what we want on our statement of cash flows. We want to include those transactions. The other possible transaction is instead of cash, we sold it on credit. Those ones we don't want on the statement of cash flows because we didn't get the cash. Doing this analysis, we also need to use the balance sheet to give us some clues as to what we actually received in cash from our customers and what we didn't. And we are going to look at the accounts receivable line. All right. Last year, our customers owed us $40,000. We are going to assume that what happened this year with that $40,000? I hope we got it. So the assumption is that our customers paid us that $40,000. Is that $40,000 included in this year's net income? Right there. Is that 40,000 included in the 60? The answer is no, because the journal entry for the revenue was made last year. We made the journal entry accounts receivable sales revenue, 40,000. But that ended up on last year's income statement. So we're saying the $60,000 of net income from this year, it needs to include this 40,000 in cash that we got from customers. And it doesn't yet. So we need to add that. So we're going to add the beginning accounts receivable. Again, we're assuming we got this cash from our customers. Now, how about this $48,000 at the end of the year? We made this journal entry. I'm going to turn that 0 into an 8. So accounts receivable, 48,000, sales revenue, 48,000. So this 48,000 is being included in the 60, but we didn't actually get cash from it. So we need to subtract the ending accounts receivable. All right, so all of our current assets are going to work pretty much the same way like this. For example, prepaid insurance. With the $6,000, we say we paid that last year. So even though this ends up as an expense in this 48,000 over here, we paid the cash for it last year. So we need to add in the 6,000 since it was being subtracted to get to the 60, but the cash was paid last year, the expenses this year. We need to add back the 6,000 and subtract the 4,000. Same with the inventory. We would add the 70,000 and subtract the 62. So all of those current assets work the same way. We would add the beginning, subtract the ending. Now, if we go back to Target's financial statements, let's look at how they do it. They just show the change in operating accounts. For example, the change in inventory or the change in other assets. They don't actually show plus beginning minus ending. They just show the change. It is what we do is we actually net those numbers together. So at the accounts receivable, we would say it went up $8,000. So add 40, subtract 48. That is a net of $8,000 cash out. So we would subtract it. And it is perfectly okay to put change in accounts receivable as just one line. And we don't have to put add beginning and subtract ending. All right, let's look at some of those other expenses. For example, salaries and wages expense. This 95,000. So right there. 95,000. And we'd say, does that mean we paid our employees $95,000 in cash? And we can say that's mostly true, but not all the way true. Maybe some of that, maybe we paid them some more that was left over from last year, or we had some expense at the end of this year that we didn't pay them. So again, mostly true, but we could look for clues somewhere else. For example, wages payable here on the balance sheet to help us determine how much did we actually pay our employees. Well, the 95,000 is being included in net income, or well, it was subtracted to get down to that 60,000. This $10,000 at the beginning of the year, that's what we owed our employees. So the presumption is that we paid that $10,000 this year, even though the expense was last year. So with liabilities, we need to subtract the beginning because we paid it this year. and I'm just going to put accounts payable because it works the same. Subtract the 10,000 because we paid it, and then the 7,000, we made a journal entry like debiting wages expense and crediting wages payable. And so the $7,000 was included in the net income as a subtraction, but there was not actually any cash. So we need to add in the ending because the ending represents expenses that were in the net income but weren't actually paid. Again, it is acceptable to net these together. So we have a negative $3,000. We subtract the beginning, add the ending. So our change in accounts payable would be, or wages payable would be negative 3,000. Again, it doesn't mean that we paid 3,000 if we put this all together in the operating section. It just means that's the adjustment that we're making to the income statement to get to a real cash number. Obviously, we paid our employees a lot more than just $3,000. But looking at the statement of cash flows, you can't really tell how much you paid the employees. You would have to use the direct method to do that. All right. All of the current liabilities work the same way. We subtract the beginning, add the ending. Subtract the beginning, add the ending. And the current assets work the opposite way. Don't worry about the cash. That's the statement of cash flows is doing this. But we add the beginning and subtract the ending. Notice it's the opposite. All right, so if you are trying to put together a cheat sheet for this, and I usually do this, I tell you to write this down. I went through this whole explanation so you understood why the numbers are the way they are. But as a shortcut cheat sheet, I put this table together. So I have current assets and current liabilities. And then we say, did they go up or did they go down? If current assets went up, for example, the accounts receivable, it went from 40,000 to 48,000. It went up, but what did we have to end up doing to it? We ended up having to subtract it. So if a current asset goes up, we actually have to subtract the difference. If it went down, for example, the prepaid insurance went down, we have to add it. We are adding the beginning, subtracting the ending. So if the beginning is bigger than the ending, we end up with a positive number and have to add it. Current liabilities are the opposite way. If current liabilities went up, then we actually have positive cash flow because we didn't pay our bills, as many bills as we did last year. And if the current liabilities go down, that means we paid more bills from last year and didn't have as many bills at the end of this current year. All right, so just put this table together. This is a nice little cheat sheet if you're working on a problem and you can't quite remember what do I do with the current assets or current liabilities if they go up or down. So keep that chart handy for yourself. All right. Now, next question is, well, what about property, plant, and equipment? We have other sections on the balance sheet. Why do I not deal with these in the operating section? Do I look at these to see if they went up or down? The answer is no, because where does the equipment go? Equipment does not go in the operating section. We handle that in the investing section. With the long-term liabilities down at the bottom, like notes payable, that is not handled in the operating section. It's in the financing section. Common stock and retained earnings, those are also in the financing section. So we don't have to deal with those changes in the operating section because we deal with them in the investing and financing sections. So when you're putting together the operating section, ignore those parts of the balance sheet. But you do have to have adjustments for every single one of the current assets and current liabilities. All right, let's compare this now to Target's financial statements one last time to see how they finish up their operating section. So notice they have net earnings, that's the net income, and then they have their non-cash expenses. So that's depreciation, share-based compensation expense, deferred income taxes. In this class, we're only dealing with depreciation and amortization, so that's the one line you would be looking for. But I did say that there are other non-cash expenses, and Target has a couple of those. Next is the non-operating items. So they have gains and losses, and we have to take those out of the operating section or the net income because, well, where did we deal with them? We dealt with them down in the investing section. All right, so we just take their effect out of the net income. Now are all the changes in operating accounts. Operating accounts means current assets and current liabilities, and we can see that their inventory, they subtracted it, which means their inventory probably went up from the last year. They have other current assets, accounts payable, accrued, and other liabilities, the effects on those. Once again, we can't read too much into this. This does not mean they spent $854 million on inventory. It's just we are adjusting the net income for the change in inventory. Same with accounts payable. That does not mean we got $1 billion from our suppliers. That would be quite strange to think about, our suppliers paying us. That is just adjusting the net income for the effect of the accounts payable change. And then we get down to the cash provided by operating activities. Once we get that, you can put together the investing section and the financing section as we discussed in a previous video and finish up the statement of cash flows with what is the total change, what did we have at the beginning of the year, and finally, what did we have at the end.